Hey everybody, my name's Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm that covers disruptive tech investing for a broad audience of retail and institutional investors across the globe. Today we're going to talk about a company called Desktop Metal, and we've put a few items on this slide, new and improved and 50% off. So let's talk about each one of those. So first of all, Desktop Metal is currently trading at exactly 50% off from what the stock debuted at when they had their SPAC. Now, I took a look today at our catalog. We have a catalog we've put together with about 400 tech stocks and various data points. And one of those data points is a SPAC flag. So I filtered on that and then took a quick look at pricing. And 1/3 of all the SPACs we've covered, all 90 of them, 1/3 are 50% off or more. That means they're trading at $5 a share or less. So the company's value has halved, but we're also not talking about the same company that existed before the SPAC. So in the last year, during 2021, Desktop Metal made 10 acquisitions. That is to further their strategy, which was to consolidate the metal 3D printing space. So they spent about $1.1 billion worth of total consideration. So that's shares issued and cash that they had from their SPAC. And they bought these various companies. Now, the two biggest on here, Envision Tech and X1, those are interesting because the acquisitions had 60% or more in goodwill. Now, we've looked at the concept of goodwill before in the cannabis industry, where companies are trying to consolidate as fast as possible and they're willing to pay inflated prices, and the accountants account for that by categorizing it as goodwill. So, for example, let's take X1. They may have ascribed a value of $7 million to something like customer relationships or brand or technology, or intangibles that are very subjectively valued. So when we consider these two large acquisitions, we need to consider that they paid a lot more. They paid quite a premium to what they could justify based on the assets they acquired. Now, when it comes to X1, they didn't acquire very strong revenue growth. Over the past, dozen or so quarters here, X1's revenue growth has been quite stagnant. So it can't seem to achieve any sort of consistency in growth. And if you look at the chart here, the red bar in the far right, that's the last quarter of 2021, where they were rolled up into Desktop Metal, and their contribution to Desktop Metal was $15.5 million, and that represented 14% overall of Desktop Metal's revenues. 66% of their 112 million or so revenues came from acquisitions, though the company did mention they had very strong internal organic growth. Now, our original thesis on Desktop Metal was that the real value to be found was in their master plan for consolidation. But we kind of overlooked or set aside the original value proposition the company presented to VCs back when they were raising all their funding, which was their production system, which back then they referred to as the production system, and then later on started referring to it as the production system P50. Now, we spoke with Desktop Metal back in December of 2019. We had a phone interview with their CTO, and he commented as follows: two major customers have already purchased the production system. One is a very large Fortune 500 company, the other was a company based in India. So this was what would have been just over a couple years ago, that there were expectations that this production system was going to be quite successful. Now, when we look at what's happening today, just this last quarter, Desktop Metal announced the first sale of the P50 to Stanley Black & Decker. And in that earnings call, analysts were probing them about P50 units they were expecting to sell, revenue contributions. In fact, in the previous earnings call, Desktop Metal had said that their forward-looking estimates for revenues didn't consider contributions from the P50. So there's questions around why they're not providing additional color on this, so they seem to be quite positive. And what we would theorize is that they've perhaps had some growing pains with that initial production system platform. So a couple comments we've listed here in the earnings call. Rick Fulop, so he's the chairman and CEO, also a co-founder, I believe. He says, I'm very happy with demand for the product, internal plans, but we are going to do it in a judicious way so that we get happy customers on the other side. Sort of implies that at one point there may not have been happy customers on the other side. And that was in response to an analyst asking about 84 orders that they had from customers, and he was wondering about whether or not those still existed and whether or not they'd be filled. And the gentleman who responded, Rick, had said, that number is roughly right, or without acknowledging that they existed or not. In fact, all the commentary surrounding the P50 was very vague. And then this is also interesting. This last quote here. This was in response to a funding round they received. It was $160 million Series E in 2019. And Mr. Fulop made the comment to Forbes, and in the research piece we've published to accompany this presentation, you can find the link to that article and read it. He said, we are funded through cash flow break even. Well, that was quite optimistic because then the company had their SPAC, and as we saw in their financials, they're just burning through loads of cash, though they plan to address that. So the impression that we would get is the initial production system didn't quite have the quality that clients were expecting, and perhaps they had to work on another generation or maybe another few generations of the product to work out some of the kinks. So we'll look forward to seeing how successful that product is for the company. Now, if you look at Desktop Metal before, right, this is the comment around new and improved. They raised $160 million from institutional investors at a valuation of $1.3 billion in January of 2019, okay? Today, they're valued at $1.56 billion, not that far off, after spending $1.1 billion to acquire 10 companies. So it's clearly a very different company than it was back then. And investors who are looking at buying the stock need to consider what it's become today. So the result is a very different value proposition. You also need to consider dilution. So prior to their SPAC, they had 183 million shares outstanding. That number's moved to 311 million shares. It's mainly because they issued 63 million for the SPAC and then used up 65 million in their acquisition spree. So it's a very different company from what it used to be. When we look at simple valuation ratios, this is something we use internally to value companies and its market cap divided by annualized revenues. Desktop Metal sits at around 7. That certainly wouldn't be considered overvalued, and it's roughly in line with the current valuation of Mark Forged and Xometry, which are just about the same. So in terms of checking back in with Desktop Metal, it's a company that we like. We have it in our catalog as a like. And the last time we checked in, we wanted color around aggregation of their X1 purchase. And we have some of that. What we don't have is color around the success or failure of the P50. So they've sold the first unit and they've ramped up manufacturing. They made it a point to talk about how they've tripled their manufacturing capability, presumably to fill all the orders, and that this is going to drive lots of growth. So hopefully they choose to provide more color to the analysts that are asking for it. And then the next step would probably be to provide a breakdown of revenues by type. So they've developed this new unit around health and desktop labs that's going to be doing services. And it would be great now that they've made all these acquisitions to provide some sort of segmentation so we can see where the growth is coming from and what their predominant business activity is once all the dust has settled. So a consolidation and complete audit of the acquired companies, that's something they weren't able to do clearly because these acquisitions have been happening very quickly and they were just barely able to roll everything up into the year end. But look forward to seeing what sort of additional metrics they can provide investors that will help provide transparency around what their actual business is, right? So the takeaways that we should be paying attention to: strong revenue growth expected for 2021. revenues of $260 million. So that would be if Q1 or Q4 2021 was around 56, then you can kind of do the math. Let's say 224. So that's some pretty decent growth that they're expecting. And revenues of $1 billion by 2025. And then there's talk of reaching break even by 2023. So that's very welcome news. They do have $279 million in cash on their books, but they were also burning a lot of cash. So to get to profitability is quite important. So we'll probably check in with the firm later. Let's say we usually check in about once a year. We're currently holding 3 3D printing stocks at the moment. We're not looking for any new candidates, but we know that this stock is quite popular. We like the company. We like their aspirations to dominate in metal 3D printing. We just need to see some more color once all the dust has settled from these 10 acquisitions. So we'll be checking back in later. Thank you very much for taking the time to watch this video. If you have any questions or comments, please just put them on the video. We'll answer them. And the article that accompanies this, again, is in the description along with past articles that I've mentioned. So thank you very much for your time.